In Ottawa right now, buying a home is not just about finding the right price, it's about whether you can get it insured at a rate that actually makes sense, whether a lender will finance it without too many complications, and whether you'll be able to sell it again when your life eventually demands it. And there are properties right now on the market quietly failing all three of these tests. The mistake that a lot of buyers make is focusing solely on overpaying for a property. Now, this is a real concern, but the bigger risk in Ottawa right now is buying a property that becomes genuinely difficult to move when you need to, where buyers disappear, financing gets complicated, and you end up selling to a pool of buyers that's much smaller than you expected for a price that's much lower than you hoped for. Today, we're going to talk about 7 property types in Ottawa that are getting harder and harder to sell right now, and what every buyer needs to know before making a purchase that they may end up regretting. Now, a couple of things that are worth understanding before we get to the list. Ottawa's market has softened from its peak. We have more inventory, buyers have more choice and more time, and that's when they get selective. The properties with any kind of complication, whether that's a financing issue, an insurance issue, or some sort of stigma attached to the house, those are the ones that are most likely to sit for the longest right now. Buyers today are also doing a lot more homework because they have a lot more time. They are reading the condo documents, they are pulling city files, and they are getting insurance quotes before they remove their conditions. So things that might have slipped through the cracks in 2021 are just not in 2026. With that said, let's get into the list. Number 1 is condos with higher fees or a history of special assessments. This is one that I'm seeing cause the most hesitation with buyers in Ottawa right now. Now, condo fees in general have gone up across the city over the last few years, and this is partly because of insurance costs and partly because of deferred maintenance finally catching up with older buildings. But the listings that are really struggling are the ones where the fee has jumped significantly in a short period of time, or where there's been a recent history of special assessments. When a buyer sees a condo fee or $700 or $800 a month, or a building that hit its owners with $15,000 to $20,000 of special assessments in the last couple of years, they start doing the math. And a lot of the time, that math, frankly, just leads them to walk away. Now, this doesn't mean you should never buy into a building where the fee is higher. Sometimes the higher fee can mean that the building is well managed and they're actually being proactive about funding their reserve fund. But you need to read the strata and condo documents carefully. Look at the last 2 years of meeting minutes, look at the depreciation report, and ask specifically whether there are any special assessments being discussed or contemplated right now. If the building has a history of surprising its owners with unexpected costs, that history will follow the property on resale, including when you go to resell it down the road. Number 2 is tenanted properties, and I find this one surprises people, but it's something that I see really consistently. A home with a tenant in place is a lot harder to sell than a vacant property, especially in this market for a couple of reasons. Now, the first is just presentation. Sellers control the condition and staging of a vacant home. With a tenanted property, you're relying on somebody else, somebody who may have less of a stake in the sale than you do, to cooperate to allow showings and keep the place in showing condition. That just doesn't always happen. A lot of the time it does. A lot of tenants are great, but a lot of the times the showability ends up suffering, and a property that shows poorly gets fewer offers. The second is the risk that buyers are taking on. Now, in Ontario, tenants' rights are quite strong. If a buyer wants to move in themselves, they can give the tenant 60 days notice, but only for specific reasons. And they're also taking on the risk that the tenant won't cooperate with moving out. Even if the new buyer does have a valid reason to move in, if that property changes hands and the tenant doesn't leave when they're supposed to, it can be an expensive and very stressful experience to go through the process of evicting somebody, even if the law is on your side. Property type number 3 is small investor-style condos. Ottawa has a significant supply glut of small condo units. Studio units and junior one-bedrooms in the 3 to 600 square foot range that were built primarily for the investor market, particularly near areas like Centertown, Vanier, and around the University of Ottawa. Now, for a while, these worked because investors were buying them and renting them to students or young professionals, and the numbers made sense at the low interest rates. That calculus has changed quickly. Investor demand in Ottawa has dropped a lot in the last few years since the interest rates have moved. And the end users who are now doing most of the buying, couples, young families, people looking for a new home that they can actually live in long term, they want functional space. They want a second bedroom or a den for an office, and they want a proper dining area. What you end up with is a situation where several of these near identical small units in the same building hit the market around the same time, and there's nothing to differentiate them except the number on the listing, the price. And that drives values down. If you're buying a small investor style condo as a home, think carefully about who your buyer will be when you are ready to sell. If the answer is most likely other investors, you are exposed to whatever investor appetite looks like at that time. And right now, the investor appetite is pretty thin. Type number 4 is homes that are on one of Ottawa's major arterial roads. Now, this one is not unique to Ottawa, but it's worth naming specifically because Ottawa has some particularly busy corridors running through residential neighborhoods. Think Innes Road, Maryvale, Hunt Club, Carling, places like that. These are roads that carry heavy traffic through the day as well as into the evening in a lot of cases, and buyers consistently avoid them. The reasons are predictable. They're exactly what you'd expect. Traffic noise, poor air quality, limited street parking in many cases. And for families with younger kids, safety is also a concern along these corridors. The buyers who do consider these properties expect a discount for their proximity to these busy roads, and that discount follows you when it comes for your time to sell. Now, a property on one of these roads is definitely not unsellable for the right person, but you're always going to be selling to a narrower buyer pool than a comparable home that's 2 streets away in a more residential area. In a market where buyers have options, which in Ottawa right now they do, that narrower pool means longer days on market and more price pressure. If you're considering a purchase of one of these properties along these corridors because the price looks attractive, there's nothing wrong with that. Just make sure you ask your agent to pull the actual sales data, separating road-facing properties from comparable homes on quieter streets nearby. Look at the price difference between those 2 types of properties and take that into your mind when you're making your offer and when it comes to resale. Number 5 is properties in Ottawa's flood risk area. Ottawa has a real flood history, particularly going back to 2017 and 2019 flooding events that affected a significant portion of the city. Places like Cumberland, Constance Bay, Gloucester, all of these places got significant flooding during those record years. Now, some properties have seen their insurance premiums climb as a result of this, even if they didn't suffer significant damage. Some have had difficulty getting standard insurance coverage at all. And when financing a home requires proof of insurance, an uninsurable property becomes very difficult to buy with a conventional mortgage and becomes a massive risk to you, the buyer. Buyers are more aware of the flood risk than they were 5 or 10 years ago. They're checking flood maps, they are asking about overland water coverage, and they are looking at basement finishing with a different set of questions than they were before these events happened. If you're looking at a property in any one of these areas, get an insurance quote before you remove your conditions. Not an estimate, an actual quote, a guarantee that they're going to insure you. Know what the overland water coverage costs, whether it's even available at your specific address, and what the deductible situation will look like if something happens. This needs to be a part of your carrying cost calculation from day one so it's not a surprise. And if you own a property in one of these pockets, understand that this is a factor your buyers will be looking at, and increasingly their mortgage brokers will be asking questions about it too. Number 6 is properties that are on leased land. Leasehold properties are less common in Ottawa than in other places, but they do exist. And buyers who don't fully understand what they're getting into can find themselves in a very difficult position when it comes time for resale. On leasehold property, you own the structure, the home itself, but not the land underneath it. That land is leased to you, typically from a municipality, from the government, or from a private landowner. And that lease has a term. Now, here's where the resale problem comes in. As the remaining lease term shortens, financing becomes significantly more complicated. Most lenders want to see a lease term that extends well beyond the amortization period of the mortgage that they're offering you. When that window starts to close, some lenders pull back entirely because they don't want to take the risk that the lease won't be renewed. Others will require substantially larger down payments. In some cases, a leasehold property can only be purchased with cash, which immediately eliminates the vast majority of the buyer pool and puts serious downward pressure on the prices. Now, there can be real value in leasehold properties. Sometimes the purchase price is, almost always the purchase price is meaningfully lower than a comparable freehold. And in certain cases, property transfer taxes don't always apply the same way. But that value is only real if you go in with a clear understanding of the lease terms, who holds the lease, and what's going to happen at renewal, and what your financing options actually look like for that specific property. Those are not things to figure out after you have fallen in love with it. You want to make sure you're looking at this in advance. If you're looking at leasehold ownership in Ottawa, have a real estate lawyer review the full lease agreement before you commit and remove any of your conditions, and have an in-depth conversation with your bank or mortgage broker to make sure that the financing options you think exist are actually there. Number 7 is aging walk-up condos with no elevator. Ottawa has a number of older, low-rise buildings, 3 or 4-story walk-ups built mostly in the 1970s and 80s. They have no elevator. These were common and practical when they were built, but they're becoming more challenging to sell today for a few reasons. The first is accessibility. Ottawa's population in general is aging, and a significant portion of condo buyers are older adults looking to downsize. A third-floor walk-up with no elevator just isn't practical for somebody like that. The second is maintenance. These buildings are aging, and many of them have deferred maintenance issues that is starting to catch up with them. This third is that these buildings often compete directly with newer, purpose-built condos that do have elevators and amenities and more modern layouts. None of this means that a walk-up condo unit won't sell. They do, often at a price that reflects genuine value. But know your buyer pool going in and know that it's narrower than you might expect when you go to resell the property. So to be clear about what I'm saying here, none of these 7 property types are completely unsellable. They all transact all the time. The question is who is buying them and at what price and how many days on market are they staying there before they sell.